Hey friends, I'm joined by my friend and colleague Jason Perz. I'm Markets and Mayhem. We're going to talk a little bit about inflation throughout history. And this is a really interesting discussion because a lot of focus has been just on single periods that we might be able to use as an analog. People have looked often at the late 60s through the late 70s and even into the early 80s. But we think that it's important to go further back. And so this is going to be the first of a series of videos that we use to further discuss inflation throughout history. But before we dive in, I'd like to welcome my friend Jason. Jason, how are you doing?
I'm great, man. I'm excited to do this. We put a lot of work into this recently. We putting together outlines and slideshows and just chatting it up about inflation and central banking for the last few days, which is a lot of fun. And I'm also excited to just do this tonight because it's cool to be with someone who's about as passionate as I am about, learning and teaching and trading and markets. And so this is going to be a lot of fun. I'm excited.
Absolutely. I'm excited too. And I couldn't think of anyone better to join me to talk about this and have some fun with this conversation. We're both, really been, like you said, kind of digging into it. And so for our audience, for the benefit of people that are out there, I think it's really important that we first talk about what is inflation, right? Because a lot of discussion kind of muddies the subject. And so let's make it really clear. Inflation is a measure. It's often used as an index or a basket of goods and services. And the measurement is focused on the rate of change of price over a specific time. A lot of inflation measures focus on year over year, but monthly and even quarterly measures are something that are worth watching. And we get data from PCE over all three intervals, monthly, quarterly, and yearly. And so it's important to get a sense as to what that rate of change is to get a better idea of how inflation may be affecting the economy and where that inflation may be coming from. And inflation measurements, they often employ this index-driven approach, but they're not all the same. So you've got CPI and PCE. CPI does more of a survey driven approach. They go to different urban areas primarily and essentially ask tens of thousands of consumers to keep track of their spending costs over the months. And then that survey data is aggregated, analyzed, and that makes up much of what becomes CPI. PCE is a lot different. It's actually based on statistical reports, primarily from the US Census Bureau. It's one of the reasons I think the Fed leans into PCE a little bit more. It's more objective rather than subjective, and the data has a higher degree of quality. Then there's also PPI. PPI is kind of like CPI, but for business. It's also survey driven, and it's showing a basket of costs that businesses are incurring and giving us a sense as to what the rate of those costs changes are over a monthly and yearly basis. So breaking it down, in the United States, we have three primary measures of inflation we look at. For the consumer side, we look at CPI, which is more survey-based, PCE, which is more statistical data, and then PPI, which is business-driven and also more service-based, or more survey-based, I should say. And what is deflation? And Jason, we've talked about this a lot lately. There's some episodes of deflation that we'll go through in this presentation. But Jason, what is deflation? Walk us through this because this is such an interesting subject matter that we've been talking about a lot lately.
Yeah, so I think first off we should talk about also there's inflation, how it's measured, there's inflation of what's happening, and then there's also monetary inflation, and then there's deflation, which is the next one that we're talking about. So deflation is when it's actually slowing to negative. Disinflation, a little bit different. You have a slide on disinflation too?
Yes, we do. We have a slide on disinflation. So, deflation for folks out there, just to be very clear, this is a drop in prices, and it's important to contextualize it as such, whereas disinflation is simply a slower rate of inflation. So when we see
Yeah.
deflation, we're talking about monthly, quarterly, and yearly drops in prices. When we're talking about disinflation, we're actually just talking about the rate of change slowing. Prices are still going up.
Yes, exactly. And we have most of the time we have periods of disinflation. We don't really have deflation, especially since the period we're talking about today is most of the time we're just in this period of disinflation happening all over. deflation being a little bit differently, a little bit more extreme, and only happens at very extreme periods of time. And we'll talk about some of those today as well.
Yeah, absolutely. I think it's a bit of it's a bit of something that gives policymakers, I would say, palpable fear. No one wants deflation in any long-term scenario, particularly if it turns into sort of a feedback loop of asset deflation. That's what can cause crashes. That's what can cause credit events. This is the sort of drivers that we had going into the Great Depression and the Great Financial Crisis. We had some of that going into the COVID crash, although it was short-lived because of the policy response and its magnitude. But deflation is not something that typically is good for the market. But given how much prices have risen, a little bit of deflation in any kind of recession that comes could be good. If we see it or not, that's a whole other question altogether, right?
Yeah, and I think that's where we're at today is so many people are calling for these extreme deflationary periods. Maybe the rate of change slows, but I really think that inflation is we've talked about this a little bit more today. Inflation is more here to stay. I think it's the primary trend right now. Yes, we'll have periods of slowing, but that's about all that we can see ahead at the moment. I can't see extreme cause for deflation. I think you do hear a lot of people talking about, oh yeah, as prices ran up so much, now we're going to be in this deflationary growth slowing period. And I think that we would see the opposite, which is we're going to see inflation with growth slowing, which is a stagflationary period.
Yeah, I think that's a really good point that you just made, that we run this dual risk. And this is a problematic scenario that's actually worse than a recessionary period. It's why a lot of economic observers actually hoped that we had a reasonable recession to cleanse some of this excess and hit the reset button. And instead, we had the sort of war between the fiscal and monetary side that forestalled the inevitable. And now we're starting to see signs that we may have that stagflation, that idea that, as Jason was saying, prices are going up, but the economy is slowing or even going into a rate of negative growth. That is pushing on both sides of the Fed's mandate in the wrong way. Because on the one side, they have the price stability mandate. On the other side, they have the maximum employment mandate. And stagflation ensures that both of those mandates cannot be met. So this is certainly not something that anyone really wants to see. But because of a lot of policy missteps leading into where we are and the structural inelasticity on the supply side that we're contending with, that idea of stagflation, I think we're on the same page, is a much more likely outcome unless there's some larger scale breakage in the financial plumbing, which at this point, it seems like the Fed and other policymakers, including over the ECB and the Swiss National Bank, are actually doing a pretty good job kind of piecemealing stabilizing the financial system as it needs to be, like the Credit Suisse buy under by UBS, or what we had happen with Silicon Valley or First Republic. These were situations that, if they weren't handled well, could have spiraled into much larger credit events, and they didn't. And I think we're seeing a new policy framework that is one where, when central banks and regulators need to respond, they'll respond, but in much smaller size and much greater specificity, which gives us a sense that the outcomes that we can expect moving forward from policymakers may be different than what we're used to. And with inflation being durable and structural in nature as a backdrop, that makes a lot of sense, because if they kick into full gear reflation mode during a period of structural inelasticity of supply, we could have high inflation for some time to come. So there's this tug of war. And, Jason, we talked about this off mic a little bit, but basically the Fed, the ECB, the Bank of Japan, these are folks that are in the most unenviable jobs possible right now.
Yes. You're in a very hard place right now, any way you look at it. They're looking for somebody to rescue them in some sort of way. Either the government wants the Fed to rescue them, the Fed wants the government to rescue them. Maybe they'll try to do a gold seizure like they did in 33. Who knows? Not saying that that's going to happen again, but just saying everybody's looking for something that the other can't really deliver right now. And thinking that, as they're tightening up policies on getting these base metals, or these other materials like oil and commodities and so on, you're also seeing the Fed raising rates, which is tightening up the ability for somebody to even open a business like that. So all of these things together really lead to stagflation. If we're just looking at that one simple fact of going, the Fed's raising rates, new businesses aren't able to borrow as much, people aren't out exploring, and then also the government regulations and policies are tightening down on all these things, you have the ultimate recipe for stagflation that you'll ever see.
Yeah, 100%. 100%. And this is a very unique era of policy missteps and so many different global drivers, whether it's geopolitical, supply and demand, or just excesses in fiscal and monetary policy kind of catching up with reality here, that this could be a bit of a period where the turbulence is more common, and where, like you said, deflation is less common, and maybe disinflation is kind of the best we can hope for. We've had a lot of that from 2022 to 2023, where we went from inflation over 8% to inflation just over 3%, and that's progress. And so let's just cover what disinflation is and isn't. Disinflation is when prices continue to rise across goods and services, but at a slower rate. And that's exactly what we're seeing, at least up until this point. We may see some reacceleration in inflation from here, but in the here and now, we've seen that drop. So, for example, like we saw last year, when we had inflation over 8%, it dropped to 5% year over year. That, for example, would be disinflation, or a slowing rate of change in prices. It's important to note, however, I want to emphasize this again, that disinflation does not mean a drop in prices. This is a common area of confusion. I see it all the time where people are like, wait, the rate of inflation is going down. Why aren't my prices going down? And that has everything to do with the fact that disinflation is just telling you prices are rising at a slower rate, which means they're still high and they're still going higher, just not as fast as they were before. Now, this seems simple to folks that are familiar with economics, but there's a lot of people out there that aren't familiar with these key terms, and that's why we're covering them as a prelude to the content that we're going to dive into.